encourage you to do your own research, and so you can check out the Insights section to learn so much. 21Shares regularly shares timely updates on key industry shifts, from ETF launches to macro market sentiment. Want to stay ahead of the curve on all things crypto and digital assets? Subscribe to the 21Shares newsletter. You'll get market insights, product updates, and trend breakdowns straight to your inbox. The link is down in my description below, so go check out 21Shares today to learn more about their products and capabilities. This is not financial advice, and all investing carries risks. Products may not be available in all jurisdictions. Consult a licensed financial advisor. All right, so this coming September dip. Since the 1920s, September has been the worst performing month for the S&P 500 on average. You can see here on this graphic made by Visual Capitalist that on average since 1950, September has an average of negative 0.72%, which is the largest decline of any one month. Look at the bar chart in yellow. Also check out what happens after September historically. 3 to 4 months of very, very solid market movement. And it's not just the S&P 500. Over the last 100 years, I looked up and found out that it's actually the Dow Jones, the S&P 500, and the NASDAQ 100, where September is historically the worst month. So why? Well, I found a couple of very interesting reasons. Number one could be investor behavior after the summer. After the summer rally, institutional investors often rebalance portfolios or lock in profits heading into year end. Retail investors may also sell positions to free up cash after the vacation season or ahead of holiday spending. Number two would be tax and fiscal year timing. In the US and elsewhere, the fiscal year for many mutual funds ends in September. That can prompt tax loss harvesting. The selling pressure drags prices lower temporarily. Third would be lower liquidity. Trading volumes are often lighter in late summer, so when selling picks up in September, it can have an outsized effect on prices. And lastly would just be psychology and self-fulfilling effect. Because so many traders and investors know about the September effect, they often act on it. This selling in anticipation of weakness can reinforce the very pattern. What does this mean for us investors? Well, for you and me that are investing for the long term and investing in very broad, solid ETFs like I talk about on this channel, this doesn't mean much. Basically, if there is a big dip in September or a more sizable dip than we've seen, then great. We've all been kind of looking for a time to start accumulating some more of those ETFs. In general, we want to focus on fundamentals, overall economic data, monetary policy changes such as interest rate decisions from the Fed, and earnings reports from companies are much stronger indicators of market direction than historical seasonal patterns. Since we're very likely to see a rate cut in September, there's actually a pretty good chance that we don't see as big of a dip in September than maybe historically we have seen, because we have kind of been waiting for this rate cut. And as of the last meeting, it does look like Jerome Powell is thinking about making that cut, but we're still very uncertain, and there's been a lot of news that's come out recently in the past couple of days that kind of flips that on its head. So this leads us to some news and some things to look out for in the next couple of weeks. There've started to be some fading Fed pressure and rate cut expectations. The core PCE inflation data met expectations, reinforcing market hopes that the Fed will cut at interest rates in September. Analysts warn, however, that rate cuts now could overstimulate what appears to be a healthy economy, citing strong GDP growth, robust labor markets, and record corporate cash flow. Honestly, with this whole rate cut decision, the problem is that we're seeing some ideas as to why we should cut, and then there's some ideas as to maybe this isn't the best time to cut. It's a very tough decision, obviously very polarized views. We'll see what happens in September, but it definitely will affect the stock market. The AI rally continues, though Nvidia was rattled. Nvidia's earnings, though strong, didn't fully satisfy investor expectations. Its stock dipped nearly 1%, but the broader AI sector surged, boosting Micron, Broadcom, Amazon, Alphabet, and others as markets rallied to new S&P 500 highs. At the same time, rising geopolitical and competitive pressures in AI, especially from China's state-backed firms, have injected a dose of caution into tech-driven optimism. There's a lot going on and a lot of uncertainty these days. All I know is that if we see a monster dip in September, I'm going to be taking the plunge right then and there and getting some money into the 3-fund portfolio that I always talk about, and definitely not waiting for that bigger dip that's possibly coming later. You saw that chart. Statistically, for the last 75 years, September is a lull, and then the next 4 months are huge gains. So just keep that in mind. Here's a video about that 3-fund portfolio. If you're looking for a super simple but solid way to invest, that's the answer. Or watch this video that I just made earlier this week that's going to keep you going strong in investing. Remember to keep investing simplified.